Hey class, this is one of my favorite topics to teach about. I'm going to go through budgeting, calculating your tax liability, and doing projections, and we'll talk about mortgages as well. The reason this is one of my favorites is because this is such a problem across America. Over almost 2/3 of Americans live paycheck to paycheck, and most of that is due to behavioral their behavior, what they do, what they spend their money on. Okay, and it can be easy to fall into the paycheck to paycheck cycle. I'm going to show you ways that you can easily fund a retirement with not a lot, get huge returns, and just by managing your money better. Okay, so and I wanted to do this just to give you an idea of what you're going to be looking at. Many of you, this is for the majority of students who are about to graduate with their undergrad. Some of you are more mature and have been through a lot of these life things already, and maybe this can help you as well. Hopefully you've already followed some of these principles. So the first thing I want you to do is think about how many are living paycheck to paycheck first. About 2/3, about 60%, depending on the study you look at, are living paycheck to paycheck. Surprisingly, about 47% of people making over 100,000 are still living paycheck to paycheck. That kind of blows you away, right? Like making over $100,000 and you're still paycheck to paycheck. We're going to look at why. There's lifestyle creep, there's reasons for it, and we're going to talk about those. The other thing I want to look at is the budget. Okay, so starting out with, well, before we hit the budget, we talked about how many are living paycheck to paycheck. What about retirement savings? Let's look at the median retirement savings in the U.S., okay? This is from the Board of Governors of the Federal Reserve System, okay? And they have this survey where they're looking at the median retirement savings by age, okay? This is in thousands. In 2022, less than 35, median retirement savings is 18,000. Seems pretty low, okay? It gets even worse where people 65 to 74, people that are retiring, their median retirement savings is 200,000. That is very low to have a good retirement, okay? So people should have at least $1 million, a lot will say, okay? So let's talk about how we can get you that $1 million easily just by making a few behavioral changes, okay? But let's start. So we're going to do, you're making 72,000 out of school, okay? A lot of the offers are coming in around that amount, maybe a little less, maybe more, okay? But let's say when you graduate, you're making 72,000. Let's look at your tax liability. How much tax do you think you're going to pay? We're doing this for a single individual. We could do it for married filing jointly, okay? And you all have access to this spreadsheet now, so you can go through and you can see it. I've automated this thing so it automatically updates. I haven't locked any of the cells yet, so you can kind of figure out what the formulas are doing, okay, and give you an idea. But don't override the formulas because then it's not going to work. Okay, so look at, if it's just a hard-keyed cell, you can change it. But if it's like, for example, the calculation of the tax, you don't want to lose that one. Okay, a huge formula I put in there, a nested if. Okay, so, but let's start with making 72,000. How much total tax are you going to pay? Well, you're like, wow, I've got this sweet offer, 72,000. I'm going to be able to, that's a lot of extra money. Well, by the time you pay federal tax, and let's go back to if you're a single individual. Federal tax, on average, $7,400, okay? In employment taxes, your Social Security and your Medicare, you're going to be paying $5,500. State tax, if you live in Utah, you have that 4.85% state tax. There's some deductions, etc., but $3,200. Sales tax, $473. Property tax I haven't included. If I change this to a yes, if you buy a house, another $1,200. So if you buy a house, you're going to be paying almost $18,000 in tax the first year you graduate. Crazy, right? That's why you'll hear tax is the biggest expense you'll have throughout your life, because 25% of your gross income is going to pay taxes, okay? If we'll do no house right now and say 23%, that's still a lot of money. So your disposable after-tax cash flows is only $52,000. You got to keep that in mind as you're budgeting, okay? A lot of people budget off of their net earnings after the taxes are taken out. What I want you to do is budget off of your gross, because there's certain tax savings, and hopefully after taking this class you're realizing there's so many tax savings opportunities. Why not budget from growth so you can figure out ways to reduce this tax liability, right? The more you save in tax, that's return on any strategy you've done, okay? Maybe you're not even, you invest in your 401k and it's saving you a bunch of money in tax. It's an awesome return, okay? So we'll talk about the strategies here, but that's your tax liability. So you're really dealing with $52,000. Let's talk about the budget, okay? I just grabbed these numbers from the Bureau of Labor Statistics, okay? So if I go to this link and I pulled it up on another tab, this is how much Americans are spending by category, okay? On average, the average American household makes $94,000, okay? And this is a household that consists of 2.4 people, so it's not a single person. I'm going to use a single person and any other consumer units. That's where we're going to go off. We're kind of basing this off single, okay? If you're married, you should change the tax formula to be married filing jointly. Maybe you have kids, add that child tax credit. I want you to update it according to your situation. But I'm going to go with the easy one, single individual. What are the expenses of a single individual? And I just went down this column, and the single individuals spend about, the average income is about $61,000, and they spend about $52,000, okay? And that's not including taxes. Okay, they're saying that taxes are only $6,000 for the average household, okay? So that's going to be low. I mean, if your income's low enough, you're not going to pay any tax. So that's the average, okay? But we want to look at you, $72,000, how much you're paying, okay? So, but I based those expenses off a household making $60,000. So with that lifestyle creep that is so common with everyone, the expenses are likely going to be higher for someone making 72. But I want you to look at this because even making 72,000, I'm going to show you how you're still paycheck to paycheck, okay? And how we're going to change that. So, annual 72,000, you're paying all your taxes, so your net, you have $52,000 to work with after taking out health insurance costs and your taxes, etc. Okay? Here's the average expenses for the American. So the average American's only giving, divided by 72,000, 2% to charity. Okay? Let 2.1% of their income to charity. Okay? I'm going to talk about how I recommend giving a lot more than that. Not waiting till you retire, but right now. Okay? It's amazing how much happier you'll be when you're blessing the lives of others, and financially is a huge way you can help benefit people, okay? So, but if you're living paycheck to paycheck, a lot of times you're limited on how much you can even give to people, okay? Insurance, okay, 264. Housing, so the average housing cost, divide that by 12, is going to be about $1,600 a month that people are paying for housing, and that amount is including all of the utilities, the rent, the mortgage payments, all of that. I didn't break any of that up. I just did the total, okay? If you buy a house right now, 30-year mortgage at median rate in Cedar City, it's $2,600 a month, okay? So budget, let's do $2,600 times 12. That's, and we're not even going into the utilities, etc. Houses have never been so unaffordable. Well, back in the 1980s it was similar, but it's bad right now, okay? Transportation, the average transportation cost just for the car payments is about $550 a month. You have gas, food. How much are we doing monthly? $6,000 a year, so about $550 a month. That might be lower or higher, okay? So I want you to go through this and see how much do you actually spend. This is the average single household in the U.S., okay? Medical services, apparel, etc., etc. We go through everything. Total expenses, and I'm not going to put excluding payroll. I'm just going to do total expenses because we actually included payroll. So total expenses, $63,148, which is including all of the costs from the survey plus all of the taxes. Okay, so 88% of your income, gross income, is gone at that point. Okay, so how much does the average American household, if students are graduating with average of $30,000 debt, something like that, okay? So the average payment I was looking was $317 a month times 12, $3,804, okay? Credit cards, Can't even remember what the average credit card debt was, but $430 a month in credit card debt, about $9,000 in debt paid for the year, okay? So how much does that leave you? You take your salary minus your $63,000 expenses minus your debt, guess what? In the bank, you have negative $491. You are officially living paycheck to paycheck, okay? If you're an average American. So, how can you get around that? Well, let's look at a few things we can do. And I'm going to do a comparison column, okay? Because I'm going to make it even worse. I'm going to say, look, give 10%. What if you gave, and maybe it's for religious reasons, maybe it's just because you're a good person. It's amazing when you have a budget of giving that you can just give out to people, how freeing it is, because someone asks you for money, maybe, and they're in need, and you can just give it to them because you've budgeted for that. If you haven't, it's really hard to give anybody money. So let's put it up to 10%, okay? Where does that put us? Negative 6,000. So what's the first thing you really should be doing? You've got to get out of debt, especially this credit card debt. That needs to be gone so fast. What's the average credit card interest rate right now? Like 24%. So anytime you're carrying a balance of $1 on your card, you're paying out an extra 24 cents each month that you're carrying that balance on whatever your balance is. It's crazy how people in credit card debt are just throwing their money away, okay? And credit card debt is skyrocketing because everybody's living paycheck to paycheck. It's about behavior, okay? Inflation's as bad as it's ever been, right? It's terrible right now. How do you avoid that? Well, you have to limit your expenses. If you don't limit your expenses and you just throw everything on the credit card, you're just going to dig yourself a hole that it's hard to get out of. That's why the average retirement savings is, the median is $200,000, meaning half of Americans, when they retire, only have $200,000, okay? So how much, if they live to 20 years in retirement, 200 divided by 20, they have $10,000 a year to live on, okay? We're not including Social Security, etc., but that's crazy, okay? We do not want to be in that situation. So the first thing you're going to do, my recommendations, up that charitable, okay? Get rid of your debt, okay? And you can't up the charitable, so it's probably you have to reverse the order and pay off this debt so you can give more, okay? But credit card debt, you can pay that off. Do the snowball. Look at Dave Ramsey. Get the snowball method going. Whatever it is, you pay off that credit card. Even giving that 10% of your income, you're only 1,000 in the hole at that point. Okay. What if you pay off your student loan? With the average American's expenses, you have $2,795. Okay, in savings for the year. How much are you saving per month? It's still not $233 a month. Still, you're not feeling great with that, right? Well, guess what? In that survey we just looked at, guess how many vehicles the average household has? 1.4. Guess what the average payment is on a used vehicle? $550. Guess what it is on a new vehicle? $700. So, on average, people are paying how much? Let's do 700 times 1.4. 980 times 12. So we did it monthly. 11,760. Okay? People, one of the biggest decisions you can make that will affect your financial future is graduating and buying a brand new car. You feel like you have all this money, guess what? You just put all of your retirement, see how that puts you into the negative? And you might solidify yourself into the group that's only retiring with 200,000. Okay? That's just, I hate breaking it to people, but that's a fact of life. And you may not, keeping up with the Joneses isn't going to work in this case because, gosh, the Joneses probably are going to have 200,000 in retirement savings or less because they're living paycheck to paycheck. Okay? But they don't show it because they have all the cool toys, etc. Okay? So, let's go back. What if you're in college right now? What if you've paid off your car? You have an old beater car. Pay that thing off. Guess what? Instead of having $6,500, $550 a month you're paying in car payment, what if it's zero? All of a sudden, we're 10 grand in the bank already, just with those small changes, okay? Gosh, am I saying never get a nice car? I hope to get one at some point, okay? I don't have one yet. And the reason is because I know how valuable it is. The earlier you start, the better. Okay, if you graduate and you're like, it's about time I have a nice car. I've been living poor through college. You get the nice car, you're setting yourself up for a small retirement savings, okay? Unless you're making a ton of money, but maybe that's few and far between. I just saw a video of Dave Ramsey show people making $330,000 still living paycheck to paycheck because they get all the cool stuff and they're making crud loads of money, live paycheck to paycheck. Okay, make these small decisions while you're in your 20s. How fast does your money grow in your 20s? Let's do that really quick. Let's say that $550 a month. Well, let's do right now. You could put $6,500. You could put $542 a month into a Roth IRA. And if we do per month, okay? So, and that's for one person. If you're married, you could do double, okay? If you did that instead of putting it into a car and you're 20, how much will you have once you're 65, okay? So we're going to do future value rate. Even if you average the S&P 500, you could get 9% return. Let's do something super conservative. If you only averaged a 5% return, okay? Lower than you're likely going to average, okay? Number of periods, 45 years, okay? And let's do what if you're putting in that 541 per month? So we're going to do everything monthly. Number of periods would be 45 years times 12. So if you started when you were 20, retire when you're 65, okay? Present value 0, and you put it in, let's say, oh wait, the payment is 541, starting at 0, type, let's say you did it at the beginning of each month, a little more growth, okay? How much would you have just at 5% when you're 65 of tax-free money? $1.1 million. Let's take it out of the take it out of the negatives. 1.1 million. Just by putting $540 a month into a Roth. If you put it into a car, guess how much you're going to have in tax-free money? 0. Okay. So I just get blown away by these things. Okay. If you make 9%, the average S&P over the last 125 years or whatever, $4 million tax-free money. Okay. Why don't you do that? Okay. But that is such a hard thing because not everyone else is not doing that. Okay. There are people that are, but it's hard when everyone's driving these super nice cars and whatever else, buying these huge houses, okay? That's how much you can have if you start in your 20s, okay? Let's keep it at 9% because that's a pretty cool number, right? What if you start, let's say you bought the car and you decide, okay, I'm going to make that monthly payment, pay it off in 10 years. I'm going to start when I'm in my 30s, okay? Like Professor Lee, 30s, okay? We're going to lock, now instead of 45 years, we're going to lop off 10 years, 35, okay? How much do you lose by doing the car and then, yeah, I'll start in 10 years instead? 11 million. We messed something, 11 billion, I think. We messed something up there. So, and I did of the 4 million. That was like 11 trillion. Okay, 541 a month, okay? 1.6, okay? So let's do the car for 10 years and then maybe I'll start when I'm 30. The car will be paid off by then and I'll do $550 a month at that point. You just cost yourself $2.4 million. That's how crucial the 20s are, okay? You have to invest a lot more in the 30s and 40s to catch up with what you could have done in the 20s, okay? And that's only $540 a month. It's mind-boggling how important the 20s are. That's why the decisions you make in the next 10 years right after graduation are so crucial, okay? So, but what happens is people in 10 years, if they're buying a nice car, guess what they do? The other one's paid off. Perfect. We just paid off the other car. Now we can buy a new sweet car to keep the cycle going until we retire and never save anything, okay? Just what's happening in the U.S., okay? So, and it's just proof that the median retirement savings is $200,000 because look at how much is usually saved for retirement. People are they're putting in about $379 a month to get the employer match. Okay, so That's why in the budget, in our original column, we have 758 because we're assuming a 5% match by the employer. So how much are they going to have? If we did that 9% return, future value, rate, 0.09, and that is 378 per year that they're putting in. Okay, number of periods, let's say 45. They started when they were 20, right when they graduated. Payment 758, present value 0, and let's do the end of the period because it's after each pay when they're paid. 398,000. Okay, so that's at that 9% return. Okay, and that's if they're contributing. So a lot of people aren't contributing because that median was 200,000. So hey, that's not bad. This person, they're living kind of paycheck. They'll have 398,000 when they retire. Great. So divided by 20 years, maybe they could live 30 years. They'll have 20,000 a year in retirement. Good for them, right? Not really. Okay, so we don't want that. We want $4 million. Okay, and there's just amazing what you can do there, and pay off that car. Look how much you're saving already. Okay, so, and then in 5 to 10 years after you've built up $1 million in your retirement or in your savings, you will feel you're in a place where you can start making purchases like that. But people do the opposite to where they don't. Okay, and we haven't cut anything else. We just cut out that car payment. We upped our charitable. Housing. Let's address housing really quick. We kind of addressed it already. The current market, and I want you to use this mortgage calculator as you're planning to buy because it kind of opens your eyes. You go into a lender or a real estate agent and they say, when's the best time to buy? It's now. Rates don't matter. Prices don't matter. And I love my real estate agent friends and the lenders as well, but gosh, I just want you to show them this when they say that to you and say, look, do you want me to spend $1 million for a house or 500,000 for the same house? Okay, so current rates. Let's look. They change every day, so let's look at current mortgage rates. Okay, average rate on the 30, 8.34. So we're going to put this at 0.0834. And the average year on the 15, average rate is 7.357. 0.07357. Okay, so this is a pretty cool calculator. Again, look for those cells that have formulas you don't want to override, but the ones that don't, you can. Okay, so like the loan term, annual interest rate don't change because you're changing them over here. Okay, loan term. If we went 15-year loan at current mortgage rates at the median price in Cedar City of $360,000, your monthly payment is $3,143 a month. Okay. And your $360,000 house is going to cost $583,000 after the end of 15 years. If we do 30-year loan, conventional loan that most people do, okay, with 20% down, 8.34%, you're paying $2,500 a month. A lot of people say, oh, I could maybe do that, right? Well, $2,500 a month, you're going to pay $950,000 for that home, $590,000 in interest, okay? What was that rate just 2 years ago? It was 0.0265. How much? Look at that total payments over the life of the loan, $950,000. Watch how much that drops just by the interest rate. The same house that would have been bought 2 years ago, $514,000. Literally $450,000 of interest just in the increased interest rates because the home prices have stayed about the same as they were 2 years ago. They've even gone up some. And the rates have gone up. So this is what would have been a $1,300 payment per month 2 years ago on a $360,000 house. That's why the houses were just flying off the market. Now with current rates, you double that payment per month, and you're paying not $400,000 more in interest per year. There's people bring up, well, you can refinance as soon as rates drop. That's a possibility, but you need to keep in mind how much houses cost at this point. That's why I saw an article today that the highest percentage of cash buyers ever is happening, okay? Because they're not affected by the rates. Property values are still high, but if you just sold a house in California for $1 million, you come to Cedar and it's $400,000, you're paying cash, okay? And people who need a loan aren't going to be able to get in, okay? So that is what, when you look to buy a house, run it through this. Look how much you're going to be paying over the life Okay? Throw your interest rates in there and see, gosh, 2,591, I think, I can't even remember what the threshold is for how much you should pay per month on your wages, but 2,591, if you're making 72,000 a year, right? Divided by 12, making 6,000, and then we have, change this to number, what was the amount? 2591. So 2591. So we are going to do the difference equals this divided by. So that's 43% of your gross. That's not even your take home. I'm sure they recommend 30 or something like that. So even real estate agents and lenders are probably not recommending it right now because that is an insane. If you're paying 43, so yeah, $25.91 a month. Again, let's just throw that in here again. And we've already saved on the car, and we were living frugally, etc. We think it's 9,000. If we decide to buy that house, and it's going to be even higher because we haven't added utilities and property tax and everything. 31 grand, you're way in the hole. Okay, so I don't want to discourage people from, oh, I'm never going to be able to buy. Something has to change. Either the market has to crash and prices drop, or the rates have to drop significantly to make it more affordable for those monthly payments for people to be able to afford a house. Okay, so we're going to say, gosh, I'm going to rent until it makes sense to buy. It's much more expensive to buy right now than even rent. Okay, so don't feel like, oh, I'm losing this opportunity, because it's just, you can see what it'll do to your budget. Okay, so at this point we've covered housing, we've covered things that you can change, big things. You got to pay off that debt first, and then be careful with the cars, because that one decision can make or break your retirement savings. It's amazing. Okay, so now let's look at, we have $10,000 to work with here. Let's look at some awesome tax saving strategies now. Okay, let's start, we jump over to our tax liability, 401k. One of the best investments you can make is that 401k match by your employer. Okay, meaning they say if you put in 5% of your income into your 401k, we'll match that 100%. That's a 100% return. Where else can you get a 100% return on your investment? 9% is great, right? So getting 100% is unbelievable. So the first thing you do, we're going to take 72,000 times 0.05. So now that we have some income, some savings, that 10,000, why don't we put 3,600 of that into our 401k to get that match? What does that do? Well, first of all, that just saved us $700 in federal tax. Sweet, we just have $700 more to work with. Okay, it doesn't save us in employment taxes because you still have to pay employment taxes on your 401k contributions, but we just saved another, okay, oops, got a period in there, almost $200 in state tax. So our overall savings is $900. So our disposable after-tax cash flow, remember it was $52,000 because of the tax. We put it through, we saved $3,600, and our disposable after-tax cash flow only decreased by $2,300. Sweet, right? Because of that tax savings. So my return, what is my return on that investment? Let's look at our budget. I built this in. This formula matches, it includes the match up to 5%. Okay, so 72, we put 3,600 in. Okay, so my investment, 3,600. My return, how much did I end up with? I ended up with, well, yeah, return, I got 100% match here, so I got 3,600, plus I also saved $900, $907 in tax. Plus, yeah, I'll even reference that. We'll leave these notes in here so you can have a look. 907, $4,506. So my ROI is going to be this divided by my initial investment. Let's put that in percentage terms. 125% return on your investment. You invested $3,600 and you came out with $8,107. I'm going to put total here. $8,107 by investing $3,600. Crazy, right? What if you just did that match? Okay, we already talked about hit that Roth hard, okay? You're going to have 4 million, right? If you just do that Roth every year, you're putting 6,500 a year for 45 years, you're going to have $4 million. That was 9%, between 1.2 and 4 million tax-free money. What if you're just doing that 3,600 a year to get that employer match? How much are you going to have? This is crazy. Let's do the same thing. Let's just copy our future value formula, put it down here. Okay, future value. We're doing that kind of aggressive 9%, the average of the S&P, but 45 periods. If you started right when you graduated, okay, and started putting that 3,600 a year in, that is our payment, 8,106 per year. By the time you retire, something's wrong again. 45, 8,106, we're working in months, okay? So we need to divide that by 12. If you ever see a huge number, like, whoa, that's too good to be true. 5 million. What the heck? This is the difference between people that retire wealthy, comfortably, live their entire life comfortably, versus those that live paycheck to paycheck and are always stressed about money. Look how much you have. You retire with $9 million by putting away $550, and that's kind of aggressive, right? Let's just go super conservative. We're going to do 5%, 1.3 million. But look how huge that compound interest is, 1.1 million, okay? Even if we're super conservative, we have a total of 2.5 million by putting away, how much was it a month? 541 plus 3,600 divided by 12. $841 a month. I'm just like, what can you say? People would rather buy a vehicle with that. And that's why the average savings is 200,000. You could have 2.3 million. Bunch of it tax-free, bunch of it in that the taxable account. So you'd have to pay tax on this when you retire, but if your income's low enough, depending on, there's strategies when you retire to be able to minimize it. So you got both in that case, okay? Well, let's talk about something else, okay? 7,200. What is my favorite tax savings account? The HSA. It's even better than that 401k because as you're building that up, well, you don't get the match in the HSA, which is pretty amazing for the 401k, but with that HSA, that money's never taxed. Okay, you get a tax deduction when you put it in, grows tax-free, and then you don't pay tax on it when you take it out. We're talking big time tax savings, okay? And if you're super healthy your whole life, then you can convert it to a 401k and just pay tax on it when it comes out. But think of the behavioral changes you're making. If you're funding this HSA and it's getting bigger and bigger, and then a medical emergency comes up, you're not like so worried about life. You're like, I have 30 grand in my HSA. I can throw 10 grand at this medical expense and not even think twice, okay? And a lot of times deductibles cover a lot of it. So, I mean, maybe you're not even throwing 10 grand, but the peace of mind that you get from doing these little things is just unbelievable. But consumerism just has overtaken. So, and I'm never going to stop beating that dead horse. So, okay, HSA. Let's look at this. HSA contributions. Let's look at, remember 2023? It's 7,300 divided by 2, right? That is the rate for single, 3650. So I'm going to change that to negative. So let's say you maxed out the single contribution. If you're on a family plan, you can do double that, okay? How much more do you save in tax? If you just do those two, now we put $7,250 into retirement slash HSA. Remember, because we made those little decisions, we had $10,000 we could work with. If you put $7,250 into HSA and 401k, you've saved $1,500 in federal tax. Okay? That's just federal. You've saved another $423 in state tax. Your after-tax cash flow, you invested $7,250, and you still have $4,000, and your after-tax cash flow is only decreased by $4,658. $3,000 return. I mean, it's $2,200 in tax savings by putting that money into to make you more secure in life, okay? $2,200 in tax savings, okay? So let's look at our budget now. We've now invested, we have $15,000, $15,571 in our savings, okay? Net worth, really, because we paid off our student loans, right? You could have a $15,000 net worth, making 70, it's making 72, spending 48 or spending 60 still, but your net worth has grown 15,000 by making these decisions, okay? So again, 15,000, if you do that every year, let's keep copying this formula, okay? If I'm doing my 15,000 a year, total amount, all of that savings, 2.6 million when you retire, okay? And that's, how much did you put away into retirement? To have 2.6 million, we put $7,650 we saved in the first year, okay? I guarantee it, all of you can do that and you're financially secure, okay? This could get huge, okay? How much could you put in if you lived super tight just for a few years at the beginning? Start that account. Remember, your most beneficial years for compound interest are in your 20s, okay? What if you start big and you talk to your spouse, significant other, whoever it is, and say, let's be as frugal as possible for 5 years, okay? Let's just do this for 5 years, but I'm talking even more frugal. What if how much could you put in a 401k? You could put 22,500, okay? What if instead of just getting the match, what if I decide I'm going to go crazy on this? I'm going to put in the max that I can for a 401k, okay? That's going to decrease your federal tax by $4,000, state tax by $1,600 almost, okay? You've seriously saved $6,000 in tax. This is what I like to do. Max out that 401k, throw that tax savings into the Roth. You just funded your Roth with the tax savings from that 401k, okay? You've just saved $6,000, okay? You have a lot, I mean, you would have to live super frugal in these standards, right? Because look at our budget. That puts you at -10 if you did all of that. You're putting away 25,000, right, with that HSA. Let's actually change that. Let's say you want to put away 22,500, including the HSA. Okay, so minus 3,650, or let's add 3,650. Okay, and these are scenarios you should run. How much could you guys save? Okay, still saving $5,300. My budget, I'm still in the -7,000, so that's where I'd have to find $7,000 somewhere in here. Where could I decrease to put that much money away? Okay, because at that point, you see, you'd still have to decrease expenses. But let's just say, let's change this. Okay, let's leave. I'm going back and forth. If you save $18,691 in 5 years, let's just do 5 years. How much would you have in 5 years? You're going to have $100,000 in retirement in retirement and other spots in 5 years. Once you have that money, you're feeling super comfortable. What if you're getting a better return than 5%? 118,000, okay, just in that short period of time. In a 5-year period, you have $120,000 in retirement now, and now you're thinking, okay, if I lose my job, it's not the end of the world. I have some backup, okay, and this is building out your emergency fund, etc. Okay, but I want you to play around with this. See what you can do. See what changes you have to make in order to decrease the tax you're going to pay and fund, like your retirement, fund your HSA, your Roth IRA. We looked at how much you could have just by putting $540 a month into that Roth IRA. Okay, so what do I leave with here? Okay, maybe we'll leave this budget. Let's take out that 22.5. Let's go back. Maybe in the first year, let's just do that match. okay? Because you still, I mean, you still have that 3,000. You have $4,000 in the bank. You've built, you're building up that emergency fund, right? And this is the order. I mean, there's financial advisors. Dave Ramsey would say, emergency fund, you got to build that up to 20,000 before you even start any of these things, okay? Up to you. If you feel, maybe start with paying off that debt, then build up that emergency fund of 1,000 or something, and then just go crazy with these accounts. Because look at that. I mean, in the first year, you save $15,000, and we looked at, that's going to turn into 15,000 a year. It's going to turn into 2.6 million if you just kept that. 2.6 million. Part of that HSA part's going to be tax free, and anything you had in the bank is going to be tax free. Anything in the 401k you're going to pay tax on when you retire. Okay, so this stuff I'm so passionate about, if you can't tell, and I hope that this can help each of you go through this spreadsheet, do projections for yourself, and make behavioral changes now, okay? This is a difficult time with inflation and everything else. Maybe you have to sell a vehicle. Maybe you have to do other things, okay? But in the end, what it's going to do is, in 5 years when you have $110,000 and everyone else is still at zero, you're going to feel like, I can help people out. I can be, because you're secure with your own financial future, you can start helping other people. It's amazing. So please feel free to reach out. I'd love to hear commentary on this or any ideas you have with it. And yeah, let me know if you have any questions.